The most immediate market impact of the Iran conflict was without a doubt in oil markets. Oil prices shot up almost immediately and kept rising for several days, eventually, but briefly, touching $119 per barrel before easing back to around 93 as we record this. On that note, I should mention that we're recording this on Thursday, March 26th, which means things are likely to have changed in some regard by the time you watch this. Short of the conflict ending, however, the overall message is still relevant. Iran is the world's 5th largest oil producer, but its greater impact is its location in relation to the Strait of Hormuz. Roughly 20% of the world's oil, as well as liquefied natural gas supply, has to pass through the strait, a narrow 21-mile wide channel that passes along the Iranian coast and at times brings tankers as close as 2 to 3 miles from land, putting them very much in harm's way. I'm sure it's no surprise, but rapidly rising oil prices generally have a negative impact on the global economy and inflation. But the impacts by geography, country, and sector are much more nuanced. Let's start with the US. We're the world's largest consumer of oil, but we're also energy independent, which means our issues are less about physical supply and more about the price. That energy independence may create a bit of a lag to when the US economy is impacted by higher oil prices, but it doesn't make us immune. Eventually, higher oil prices feed into the cost of manufacturing and transportation and result in higher prices for the end consumer. Geopolitical events situated far from home can have significant inflationary consequences. And we only have to go back to 2022 and the fallout from the Russia-Ukraine conflict to see that. While there were other factors at play in 2022, energy price moves accounted for 1/3 of the peak 9% inflation rate. We may not have a supply issue, but higher inflation could cause demand destruction, keep the Fed from lowering interest rates, and likely impact elections in the fall. The longer the conflict lasts, the greater the impact. Higher oil prices mean something quite different for parts of Europe and most of Asia. And it's why many international markets, after a very strong start to the year, were hit harder during the recent sell-off. Many of those countries are significant net oil importers, and as such, they have both a potential supply issue and a price issue. Next to the US, China and India are the world's largest oil consumers, but neither are anywhere close to being energy independent like the US. A prolonged conflict with Iran or disruptions to the Strait of Hormuz tanker traffic would be broadly inflationary, but its ability to disrupt economic activity would be greatest in those that rely on the region for their supply. Thank you for watching. If you want help thinking through the current situation or understanding how it may impact your portfolio, please contact us at the number or email shown at the close of this segment.